This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Welcome to Breaking Banks Europe, the #1 global fintech radio network. This is episode 265, News from the Fintech Front, April 2025. And I'm joined by Amine Berraoui. He's an ex-banker turned financial inclusion advocate and the founder of a fintech called Finware. And also by Guy Stiebel, Fintech Plumber and regulatory nerd, according to him. So before we dive into the news, I would love to hear more from Amine about what Finware does, and then we'll get started.
Thank you very much, Liz, for the invite. Finware was born from real pain and real need that we felt building previous startups and previous fintechs in emerging markets where it was extremely difficult to integrate the financial system, as is getting harder actually in Europe as well. But in emerging markets, it's even worse. So what we did as Finware, we wanted to enable the ecosystem and the fintech development in emerging markets in general. So what we do is we connect. We do the heavy lifting of regulatory coverage, connectivity into different countries, different jurisdictions, and we offer this to a single API to enable fintechs basically to launch within weeks in a specific jurisdiction and scale through the same connectivity, if you want, pretty much instantly through our platform.
And did you tell me that you're connected in 37 markets?
That's right. Predominantly in Africa and Middle East at the moment. And we're looking to expand later to other jurisdictions in LATAM and Asia. Perfect.
Thank you for that. And Guy, do you want to say anything about, how we introduced you? Because I think that's always intriguing.
Yeah, I think Amine and I probably have a lot of line on this one. I call it plumbing because it's all the stuff you don't want to look at, but when it doesn't work, everything is on fire. I qualify ledgers and accounting, compliance, risk management, and data maintenance as plumbing. It's like a lower level beneath infrastructure. And what I do is mainly kind of focus on the contracting work around that stuff, figuring out how to operate the fintechs, figuring out what's the best jurisdictional layout, how do you keep the data, what type of data, and all the chaos that comes with it.
And we're going to be talking about some of that chaos. And the first chaos is good chaos that I want to talk about. It has to do with fundraising. So FNZ raised $500 million to fuel their long-term business plan. I'm going to ask Amine to get us started by telling us a little bit about this.
Yes, I mean, it's pretty amazing, their journey. They've been around for a while, close to 20 years. But I think it's pretty significant in terms of trend as well we see in the market. So first, in terms of their positioning as a wealth tech, they're very differentiated versus the other players because they actually occupy the whole value chain in the wealth tech. They go from portfolio construction to portals to orders routing as well as custody, trading, etc. So really they play for the whole financial institution aspects. The other part is they have a really large size and sticky economics. So they have 1.7 trillion actually under management, close to 24 million investors pretty much on their platforms, 600 financial institutions. So that makes them really recurrent and sticky business in terms of economics, which is quite attractive for the investors. And finally, I mean, they really executed M&A playbook through the ledger by doing very large acquisitions, and that allowed them to grow fast. They recently acquired YieldX. They acquired Dymos in Germany, Luxembourg as well. So, I mean, they've been quite significantly occupying that space and being the major player. enhance the flow of investment into them as a name. And I think this is also, as we can see globally, there's a clear shift. I mean, in the 2020, 2021, there was a lot of investment in front end plays. And at the moment, the flow of investment is going more into infrastructure plays with recurrent revenues, with large sticky client base, and that's for two main reasons. Or for one reason mostly is that the exit path is kind of closed for the front end fintechs in terms of IPOs, etc. The window is closed at the moment. However, for infrastructure play, we still see large acquisitions by the likes of Visa, MasterCard, etc., etc. So that makes it extremely attractive for investors, and I think we're going to see this recurrent pattern at least for the coming months.
Guy, would you agree with this?
Yeah, yes, but I have a different read from what I see in it. It's like, for me, this is the biggest shot across the bow of something that was only banks allowed to do. Wealth management was always a discussion like, oh, this will never migrate. It's a personal trust thing. Nobody in the high net worth will trust an app, which I'm assuming all of us that did enough conferences heard this. And it's kind of the same line that was said about banking and lending and everything else. And I think this kind of states that whenever there's a stagnant service market, there's room for fintech, specifically in the financial service area. There's really a big room for fintechs to really quickly walk in and kind of land grab some of those clients that are not fitting those very structured banking structures. So that's one. And I think that—
Could I just say something to that? Because it seems like it wasn't a quick land grab if they've been around since 2003.
It is in terms of banks. Like, who you compare? I'm putting them against everybody else that's doing wealth management. It's like, oh, we've been doing it for 100 years. And like, oh, we can do this in less than 50. But I agree. It's the fintech is insulated from, and you said it with the front end applications. It's not a standard tech industry. Doesn't look like a standard. It happens to have developers in it and it uses software, but it's not a standard tech industry. And as such, the time scales are different, and the sizing, and also I think the reality of what exits are actually out there for fintechs is different. And it kind of comes up when you're talking about the difference between infrastructure and application fintechs.
So I have a question. How many wealth techs received this much funding?
I don't think I didn't see this kind of funding.
Exactly.
Yeah. Because again, like most of the wealth tech, they focus really on front end, robo advisory, managing your assets, blah blah blah. I mean, it's very different from which is really the foundation. And coming back to Guy, is like the plumbing of wealth tech. So I mean, it's obviously they're taking the lion's share.
So from an infrastructure to something that's more, at least when they launched, in my opinion, front end UX, Revolut. Yeah. So they were fined 3.5 million by the Lithuanian Central Bank for AML deficiencies. Guy, you want to tell us a little bit about that?
Well, it's like, we all know this story. This is a repeat. It's not a repeat for Revolut. It's like, oh, you're officially a bank now, and now you're going to get fines for missing stuff. I always kind of, because I've done this for long enough with institutional banks and with smaller institutions, and the language in the industry is really like, oh, this just happened. It's like loss. It's like, if you have a shopping center, people will steal stuff. If you run a financial institution, you're going to have AML fines. On a personal note, I don't like it as an approach. I think it's kind of giving up in the beginning. But it's kind of that, I think they experience that point of scaling as they are the poster boy. And when you are the poster boys, the regulators look at you. Which means,
why are they the poster boy?
Because they're the biggest, most profitable one that actually succeeded in addressing multiple markets as a neobank.
Why did they succeed in addressing these multiple markets?
I think that it splits into two. One, they figured out they don't have to be a bank in the beginning. You can reach, which I'm assuming that Amine experiences in Africa, you can reach service parity with other stuff. You can use cards to generate the same experience as a bank account. And I think they hacked it before anybody else understood that you can take an issuer and create a debit card and do multi-currency debit cards and effectively create a multi-currency account without having a banking license, without being a full-fledged bank. And that is a hack that meant that everybody else was chasing, because everybody else were doing banking licenses. Everybody else was trying, N26, everybody else was trying to set up banks.
And did it take much longer for everybody else to get clients because of that, or not really?
So they got clients on the uptake, but the problem is if you look, I'll take any N26 as an example because I think it's a nice example. They went market specific, European, they got their banking license and they started running. But very fast, they found themselves in a fist fight with Buffett on security and on a lot of other stuff because they were like, you're a bank, act like a bank. Revolut succeeded in becoming very, very big in a lot of places without actually being a bank. They studied what I will call the PayPal playbook, which is, I'm not a financial institution, I'm not a financial institution, I'm not a financial, oh, okay, I am a financial institution, but I can afford being a financial institution right now.
Now I can afford it and not that.
Exactly. So I think they did the customer capture by not being so expensive, by just being a card. And other thing is, I think they're stretching the limits of the passporting. I think they're pushing the concept of passporting in Europe and getting clients from different jurisdiction under one license to the limit of the what I call the light licenses, and then trying to stack all your clients into them. And I think that is a part of why they're getting fined.
Okay. But let's look at that licensing for a minute, because Amine and I were talking about this earlier, that, in some ways, Europe is much easier market because of this passporting, and the US, 51 states, they're different, right?
So I think that the difference is actually in the fact that in the US, you get federally mandated. So if you're set up in the classic example would be like Anchor, that wanted to do a crypto financial services. They went, I think, to Alaska to get sanctions. So it's a smaller states. It's easier to get sanctions. So it's very similar in that aspect to the passporting. The difference is that I think that the benefit in Europe is actually the fragmentation, is that you have a lot of locally flavored markets that you can access through a unified market, where in the US is not actually fragmented. There's not that many banks, and they're very dominant.
Okay. That's true. That is true. But if you want to play in Louisiana, you have to have the proper license to play in Louisiana. Not that many people would want to, but I'm just saying. Other thoughts?
No, 100%. It's much more as you talked about the limits. Just coming back to Revolut as well. One of the early uses again, that because Revolut played on the FX margin and the transfers, etc. One of the early uses that generated virality, for example, is that people were sending cards to their families all over the world and just loading the card instead of sending remittances, etc. So the virality was really good, and now they're actually trying to acquire licenses in other markets to grow. But coming back to the US, the US is again, like, if you want to, as a fintech, if you want to expand to the US, in Europe, you have a passporting across all Europe. You have access to 500 million users. In the US, you have actually to get a license for every state. Crypto is a bit different, but if we look at more regular fintechs, you need a license per state. So usually people go for the 3, 4, 5 largest states, but that's still significant investment, and of course exposure from a legal standpoint, etc., to a system which is very, very different from Europe. So far, there's no success story really of European entities scaling into the US. We didn't see that.
Yeah.
We didn't see that. Yeah.
I'd agree. Okay, now moving on to Bunk, they are actually achieving profitability and expanding into the US. So is this a huge risk for them, since nobody else seems to have been able to do it before? Guy, you want to tell us a little bit more of your thoughts on that?
So it smells like investors, and I don't know if it is, but it smells like investors. It smells like you have a US VC fund in your cap table, and they don't see you in the US, and they don't understand why they invested so much in a bank. Not in a bad way, but I think that a lot of the psychology of investors, if they don't understand the European market, and you're big in Europe, they go like, all right, cool, you did your test run. Now go to the big boys market. Now, again, and I think Amine said it correctly, it's a bigger market in Europe as far as the expressibility. It's a larger market. It has bigger satellite markets, but from where the investment money is still the US. The big tickets, the big investments are US investments. Maybe UK a bit, but still like the predominant VCs are American. And I think we're seeing this route a lot of the times where a fintech that starts outside of the US starts getting traction. They're getting a big round from an American VC. And part of the terms of that round is that you need to expand to America. You need to go to the US market. And I think Amine is right. Historically, this didn't pan out very well. It works in acquisition. It doesn't work in expansion. Like historically, if you buy a good brand in the US, you can kind of pour your business into it and expand. It worked for banks. Again, big banks. It didn't work for little banks. It worked for BNP with like Bank of the West. Santander did it with lending by getting into the markets. So when Europeans, financial institution, and I'm treating bank for a second as a financial institution and not as a startup, when they go into the US market, the upside they have is their money is effectively cheaper because the European market is not as speculative as the US market. So they can do more. They can inject capital when there's capital restraints in the market, and they can get in and be very effective, i.e. the cases with like Santander and BNP and other of those banks, because they can come in with money. When it's a market capture, i.e. getting in with a new brand and introducing a new brand into the US, like what Bank is trying to do, if they'll succeed, they'll be changing years of paradigm for me of doing this, because it's so difficult to get into that market, both from the regulatory side of it, as we mentioned earlier, but also psychologically, it is an entirely different consumer base.
And one thing, if you talk about the regulatory side, it's not a level playing field. I'm really sorry, but you're coming from outside the U.S., they're going to be tougher on you. They just will. And Amine and I know this because we both worked at ABN AMRO and have seen it in play. So moving on to, sorry, Amine, did you want to comment on the Bunk case?
No, I totally agree. I mean, let's see how it's going to pan out. But from my perspective, it's a very tough play from customer acquisition, from a number of angles. But just you enter in a very, very different and complex regulatory environment. So, of course, when you have the firepower and you have the funding and you can establish yourself, you basically go as a bank with an army of compliance lawyers, etc., to make sure that you stick.
So expensive.
The 50 different regulations, etc. That's a different play, but I think it's. I mean, if they succeed again, it's going to be
Game changer.
Game changer. But I think it's tough.
Yeah, I think so too. So let's move on to other kinds of great game changers like cryptocurrency type of things and regulation around that, Europe versus US. Guy, you want to tell us a little bit about, MiCA versus the Genius Act and some of the things that you're seeing happening there?
So I think we all noticed that we are in a kind of a war of philosophies about money between several blocks. I don't think it's a two-block issue. I think it's the US, Europe, and Singapore that are representing fundamental approaches to how the regulator deals digital assets and who are the players that are supposed to be dealing with digital assets. And it's kind of split between what is the use case that each one of those players think that is the role of digital asset. Europeans, as Europeans are, it's a risk. It's a giant risk that they don't know how to ingest properly. So they're putting some guardrails on the side right now and they're baby stepping it. Small regulations, small institutions start building up, and very Eurocentric. To the extent that there were notes in the last release from the central bank that kind of states that a foreign entity won't be able to own a MiCA compliant institution. Like the local director has to have a board seat on the top entity, like a lot of requirements that are as I say, for people that are not used to working in the continent, this is European politeness. They're telling you to shove off. They're just telling it very nicely in 17 pages of regulation. But they're telling you to go away. And the American approach, the Genius Act is, again, it's an act. It's not a law yet, so we can't tell how it will pan out. But it appears to be grandfathering in all of the banks, blocking out all of the fintechs just by the capital requirements, what allowed use cases, what type of businesses they're allowed. So just to put it in a quick snippet, I think that will kind of put the point into it. A bank is allowed to open a stablecoin operation as part of everything else they do, but a stablecoin operator is not allowed to do other things. So that is basically saying, let's get Jamie Dimon and all the big guys to get into the stablecoin game, because we looked at what happened with the ETFs and we want them to pump money into that because it's a good financial tool for us, because the agenda of the US market is to have as much capacity for what I call rogue liquidity. They're printing money out and they need to move it. It can't go back into the market. They can't keep converting it to USD because they need the USD to be in a certain. For them, it's a broader aspect of looking at how they can manage that event. The other thing is they put what I will call a non-regulator on it. They put the OCC, which is the Office of Currency Control, which is the Secret Service. So it's not the FCC. It's not a big regulator, which is, again, it's very Republican. It's very libertarian, unregulated. Let's just let it run. But it feels as let's try to keep the certain state of affairs running, where in Europe, like Europe likes to do, there's something new and we are going to anoint a new class of services to take care of it. So that's the MiCA.
The stable coin limits, they kick in June 30th. Is that correct for MiCA?
Yeah. And the stablecoin limits are really saying that Europe is looking at the risk. They're not looking at almost anything else. Like delisting USDT as an act is a risk act. It's not a profitability act, because Amina knows this probably. I've done Nigeria for a while. If you don't accept the USDT liquidity, you're shutting down $1 trillion of US dollar liquidity that is in Africa and Southeast Asia and Latin America. That's where they don't have USDC. They don't use USDC because they couldn't mint it. So all they have is USDT. And the fact that it's delisted in Europe means that now it became toxic for European Web3 operators. So anybody that wants to deal with cross-border payments from Africa right now has to find a safe port to convert from USDT back to USDC so they can pay out in Europe. And brings our third country into the play, which is Singapore, that kind of adopted the right approach, which is banks are sponsors, operators are operators, and operators will run the currency, and the banks are the sponsors for that. You need a partner. You have to have a partner that is a financial partner to back you up if you're doing this, which is kind of more banks need to be involved because the old money needs to be in the loop. But the terms themselves are like, this is a security currency. This is how we're using it, and it's a lot streamliner. I would say that Singapore has the market approach. I think the more sensible market approach. The US is looking at it as a secondary liquidity pool. And Europe, like a lot of things, looks at it as a threat and waits for other people to figure out what's happening before they need to kind of full tap in. Because
that makes sense to me. I mean, what are your thoughts on this? And then I want to move to AI. Yep.
Yeah, pretty much aligned with Guy. I mean, again, if you look even in the early 2010s to 15, like crypto was still like free word, anarchist, we're going to bypass the system, etc. And I mean, as it becomes larger and larger, and it became an asset class in its own, I mean, it was obvious that all the authorities will bring it under the system. And what we see now is like, I wouldn't say it defeats the purpose, but like it just becomes part of the regular financial system with the same hurdles, with the same blocks. Like if you're doing crypto out of emerging markets, it's going to be money laundering. It's going to be, and it's going to become just the old financial system. Unfortunately, that's the reality. Like all the hopes and the expectations that were there around the crypto and the Web3, from a financial standpoint, and from it's like it just for me just disappearing at the moment.
Okay. I want to add one point on this one, because and maybe it's just me. Friction is a feature. It's not a bug in financial systems. And if we keep treating it as a bug, we're not understanding that we are in an interest-based system, that parking money makes money. So for a SWIFT member, If every transaction has to stop in their bank for 3 days to approve, that's money. The entire system is kind of dependent on money stopping in multiple places because a lot of their model is that interchange and that movement of funds as a correspondent system. So when you're introducing into that system something that goes from point A to point B without talking to anybody, and doesn't have to stop and check and say go, and doesn't have to stop and pay interest on the way out, and doesn't have to be converted. If I take a traditional cross-border system, then it's a fundamental threat to the way money works. The anarchists, as you said in the beginning, they were right. But the system is just really big, and it goes like, all right, we're just gonna turn you into a part of what we are, and that way we can still enforce those frictions, because those frictions are what you're trying to help in Africa. Is those frictions are kind of intentional. They go like, this market will be slower than this market, and now we can have arbitrage between those two markets because this market is slower than this market. And so it's kind of challenging that. I don't know if it will succeed, but...
Okay, well, let's see. But one of the things that seems to be succeeding at the moment has to do with fundraising and AI. So in the first quarter, AI, the AI tag got what, $120 billion in raises, and I think it was led by OpenAI's mega round, and then Klarna has a GPT-powered assistant that, like, there's so much going on. Guy, tell us a little bit about this and what you're seeing with, one of every 5 VC deals worldwide last quarter being AI related.
I'm not as buzzy because I've survived the cloud transformation and the blockchain hype and then the identity, and we have done this. So like the numbers get bigger because the market is bigger. But as far as like a trend cycle, this is a trend cycle. There's something here that is impacting fundamentally, but nobody's sure still how. So people are placing bets. And I think what we're seeing is a betting market the same way we saw it in crypto when crypto boomed up. It's a betting market on a use case. My personal note on it, that it feels like if I take the book from the cloud, let's say transformation of computing and enterprise computing, what we're seeing is the same kind of event. They're trying to, although it's synthetic, I think so at least. I think the cloud providers are synthetically trying to bind the models to the cloud platforms so they'll stay in the game as it moves forwards. But what we're seeing is effectively, I will stick to the fintech space here, is it impacts 3 major aspects of fintech and on the ongoing aspect. One is the risk models are going to be changed drastically in a bit. I don't think they finished training new like language model-based risk evaluation, but the ability to ingest just unbelievable amounts of semi-structured data and then build a custom risk model for a client is something that's happening, and that's something that's going to create a lot of change. So that's one. The obvious one is the customer support and the workflow automation. Yep. And I put them in the same space because they're basically automating human interactions. They're taking input, outputs, and the last one, which I think is the biggest one, is delivery velocity is going to be fundamentally changed. If it used to be 10 people to create a widget over 3 months, it's 1 person to create a widget in a day. And that is a drastic change in the ability of solopreneurs or go-to-market or all of those people to kind of build stuff and go out, but also for the bigger fintechs to start having a lot more flavors of what they do, because suddenly building consumer applications is easy. So you can have hyper-localized versions of your book or of your app or your whatever you're doing really quickly. So those are the changes. And as such, you're either betting on companies that are building with AI so they can get the market faster, or companies that are giving AI tools to enterprises, which is the infrastructure and the more longer play. But in the end, it's another piece of tech. So it's going for applications, infrastructure, and the maintenance of that application infrastructure relationships. And those are the companies that are bubbling up right now or getting built as players. At least that's my read to the onslaught of powder that's being thrown at the industry right now if you have AI in your tag.
Thank you. Amine, thoughts on this?
No, the same thing. Like I've been through all the bubbles. Like it's the same thing. So So typically you have the new fashion, and then it's a bubble, and then it explodes. But then the serious, really long-term players remain after that once the dust settles. And I think like there's a lot of noise at the moment. 80% of it is like front-end agents helping you to do X, Y, Z. Those will disappear. I mean, not all of them, but most of them will disappear over time. And then we'll start seeing like really serious trends. And as Guy said, I mean, one of them is really around the credit scoring model, where the ability to manage data and come up with like really performing models is going to be allowing you to do instant loans and instant distribution globally, where in markets where it's extremely difficult to have access to data. When I speak about emerging markets, for example, credit scoring is much more alternative credit scoring is much more difficult in UK or Europe, where data is available about anything and everything. So that's a big game changer in terms of lending capability. And then the infrastructure layers, of course, again, as Guy said, in terms of being able to develop and ship quasi instantly localized version of things. But probably there will be use cases we don't know at the moment, and that will come. We
can't predict everything. Yeah. So just before we end the session, I want to make sure that, there's something that, is there something that we missed that you still want to cover, be it crypto makes a comeback? I don't know. So just opening the floor to see any other news from the fintech front in April 2025 that we didn't cover that you want to address before we sign off.
I would say one thing that when I looked at the investment report, and I found myself having this conversation a lot last week, and it's a bit antagonistic, so I'm going to start apologizing, but it's like, fintech is two industries. It's not one. You have consumer-facing fintech, you have financial service fintech, you have B2B fintech that's doing financial services for one another. That's one side of fintech. There's another side of fintech that's enterprise software that happens to be looped into this fintech discussion, but those are very different. And I spent most of my career in the enterprise software side of it, and then I moved to building the actual financial institutions. And I think that I have a sneaky suspicion that this year of AI is going to be the year that kind of splits those two, because the way those two different entities need AI in very different ways, and it's going to very cement their differences, because some of them are infrastructure players. They're selling software, they're selling pieces and tools that are used by other enterprises. And the other are financial players, and their market is margins. They're not in the licensing field. They're not selling seats. They're doing margins on FX. And those are very different business models that sometimes, on an honest opinion, shouldn't be in the same tent, because it's a different investment model. It's a different profitability model. And I think that AI is going to enable a lot of people to do really quick consumer-facing financial applications. And that is going to kind of pull them away, because they're going to do smaller ticket sizes. They're going to use the banking as a service to just plug themselves and go out. They're going to use the credit cards to do that. And suddenly, that co-op of a giant, big tech-heavy industry that is really, really important for us to enforce the tech in the fin, wherein the money comes from the fin, it doesn't come from the tech. And that kind of splits, I think. My suspicion, we'll start seeing it on the VCs kind of splitting their bills and saying, like, this is consumer fintech, and we use one investment hypothesis to work with them. And these are enterprise software. They're selling ERPs. It's fine that they're doing movement of money, but those are ERPs. Those are asset management systems. And those are different companies. And I think that is I've been seeing it a lot lately, so it's kind of came up.
Thank you. And Amine, any last thoughts before we sign off?
Just to build on again, I'm putting my emerging markets hat, but just to build on what Guy said, like a lot of the startups, the builders will be able to ship products quickly, but if there's no infrastructure layer, they have nothing to ship. Exactly. And the problem in a lot of the emerging market is like the VC play is still around front-end consumer-facing startups, because there's no patient money. So there's no VC or there's no money going to invest into large, long-term infrastructure play that will actually enable the whole ecosystem after that. And that's a bit still the paradox of emerging market investments at the moment.
Thank you for adding that flavor and that layer. I'd like to thank the two of you for joining me today. Very interesting month with news and wonderful to talk to you. So thank you so much.
Thank you very much.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with Fintech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.